All right, let's get right into it. Today, we're taking a hard look at the Canadian housing market because something really strange is happening. The official story we're being told just doesn't seem to match up with what people are actually experiencing.
I mean, does this feel familiar to you? You turn on the news, you hear inflation is cooling off. Maybe it's near that 2% target, but then you look at your own bills and it feels like you're living in a completely different economy. It's this crazy disconnect, and trust me, you are not alone in feeling it.
So what gives? Is the official data we're all looking at just broken? Or is there something much deeper going on right under the surface? You know what? For this explainer, we're going to treat this like we're running a bug report on the economy. We're going to dig into the data, find the glitches, and figure out what's really going on.
Okay, so our investigation kicks off with the biggest expense for pretty much everyone, housing. And this right here is where we find the first major glitch in the system. And oh man, it's a big one.
Okay, check this out, because this gets right to the heart of the whole mess. When the government calculates its official inflation number, the CPI, for rent, it looks at all leases. That includes people who signed a lease 2, 3, maybe 5 years ago. But if you're out there right now trying to find a new place to live in a city like Vancouver, the story is the complete opposite. The asking rent for new movers has actually dropped by almost 8%. They are literally measuring two different worlds.
So that gap between the two, it's a whopping 12.6%. That is not a small discrepancy. It's a chasm. And it's our first major clue that the headline numbers are totally masking a really painful correction that's happening for anyone actually in the market today. So let's follow this clue and see where it leads.
And this data glitch, it's not just some weird statistical quirk. No, it's a symptom of a much, much bigger problem. A problem that starts right in the engine room of Canada's urban growth, the pre-construction condo market.
And this brings us to a really critical idea, the appraisal vacuum. So picture this, you got excited and signed a contract to buy a condo back in 2021. But now it's finally built, say in 2026, and the bank sends an appraiser who says, sorry, this place is worth way less than you agreed to pay. That huge gap makes it pretty much mathematically impossible for you to get a big enough mortgage to close the deal.
And this is not some small abstract problem. For a regular 600 square foot condo in Toronto, that gap, that shortfall, is over $170,000. I mean, who has that kind of cash just sitting in a checking account? This isn't people changing their minds. This is a financial brick wall, and it's the trigger for a whole cascade of defaults.
And this is how that one problem spirals into what the industry calls the receivership waterfall. It all starts with that appraisal shortfall. Then the buyer, well, they can't close. The developer runs out of money and defaults. The lender has to step in, takes control, and puts the project into receivership. And the receiver's job? Cancel all those old contracts from 2021 and sell the entire building off in one big chunk, usually for a fire sale price.
And it's not just the people trying to buy. Just look at the pain for the small mom-and-pop investors who actually did manage to close on their properties. With today's high mortgage rates and those falling rents we just talked about, a shocking 82% of them are stuck in this negative carry trap. They are losing over $1,000 every single month. They are actually paying out of their own pocket just to be a landlord. They are subsidizing the rental market.
Okay, so if the little guy is getting absolutely crushed, you have to ask, who's winning here? All this chaos, all this distress, it's created a golden opportunity for the really big institutional players, the ones with deep pockets.
So where did all this missing supply go? It didn't just evaporate. The data shows that in 2025 alone, over 27,000 condo units that were supposed to be sold to individuals were instead converted into massive, purpose-built rental buildings. The supply isn't disappearing, it's just changing owners.
And this is where you see this huge split, right? On one side, you've got the individual investor, just bleeding cash every month. And on the other side, you have these huge institutional REITs, that's real estate investment trusts. They're basically acting like the lender of last resort. They swoop in, buy up these entire distressed buildings at such a deep discount that the math suddenly works great for them. They're cash flow positive from day one.
And here is the really crucial long-term impact of all this. What used to be the main way for regular families to build wealth and get ahead, owning a home, is being systematically transformed into a lifetime of renting from a massive corporation. This isn't just a blip, it's a fundamental change to the fabric of Canadian society.
But hold on, because the story doesn't stop there. All this pain in the condo market is now seeping into a much less visible but incredibly important part of the financial system, the world of private lending.
Some people call it shadow banking. To really get the risk here, you have to understand something called the capital stack. Think of it like this. When a project goes bankrupt, the senior lenders, those are usually the big, stable banks, they're first in line to get their money back. They recover almost everything. But the junior lenders, the ones who took on more risk for a higher return, they are last in line, and they get almost completely wiped out. And that wipeout is starting a chain reaction. See, a lot of these junior lenders are things called mortgage investment corporations, or MICs, and they're funded by everyday retail investors. As the losses pile up, huge funds like Romspen have been forced to gate redemptions. That's a fancy way of saying they've slammed the door shut and frozen billions of dollars of their investors' money. For some, this has wiped out years of hard-earned return.
Now this might just be the most important slide of them all. The market is now pricing in a 90% chance that a major failure in this private lending world would trigger a crisis at one of Canada's big 6 banks. What that means is the firewall people thought existed between the shadow banks and the real banks, it's basically gone. The risk has spread to the entire system.
Okay, let's step back for a second and connect all these dots. We've seen a data glitch, a collapse in the condo market, a huge institutional takeover, and now a freeze in the shadow banking world. What does this all add up to for the future of Canada's economy?
Here's the final, and maybe the weirdest, piece of the entire puzzle. We're seeing building activity in Toronto at its lowest per capita level since 1996. Thousands and thousands of construction jobs are just vanishing. So, why isn't the national unemployment rate going through the roof?
The answer is this really wild concept called the demographic heat shield. Basically, because Canada's population growth has hit a wall, the economy needs to create almost zero new jobs just to keep the unemployment rate looking stable. So, you can lose 100,000 jobs in housing, but it gets completely hidden because there isn't a huge flood of new people looking for those jobs anymore. And this points to the strange new economic reality we're now living in. The country as a whole can actually be getting poorer, major industries can be shrinking, but the headline employment number still looks totally fine. It's the ultimate example of the official data being completely decoupled from the real economic pain people are feeling.
Which brings us all the way back to our final question. When you connect all the dots, the appraisal vacuum, the negative carry trap, the institutional takeover, and this weird demographic heat shield, a pretty clear picture starts to emerge. So I'll just leave you with this to think about. Are we just watching a normal market correction, or is the Canadian dream of homeownership being systematically taken apart and converted into a permanent future of corporate tenancy?